Today, we're tackling one of the most common questions in personal finance: Roth IRA or traditional IRA. Which one is better? Now, before we dive in, quick disclaimer. I'm not a financial advisor, and this isn't personalized financial advice. Everyone's situation is different, so definitely do your own research or talk to a professional about your specific circumstances. What I'm going to do today is break down everything you need to know so you can make an informed decision. Sound good? Let's jump in. First things first, what even is an IRA? IRA stands for Individual Retirement Account. Think of it as a special container for your retirement money. The container itself isn't the investment. It's more like a wrapper that goes around your investments and gives you tax benefits. Inside your IRA, you can invest in stocks, bonds, mutual funds, ETFs, pretty much the same stuff you'd invest in anywhere else. The magic isn't what you invest in, it's the tax advantages that come with using this special retirement account wrapper. There are two main types: traditional and Roth. And between them, and the biggest difference between them, let's start with the traditional IRA because it's been around longer, since 1974. Here's how it works. You put money in now and get a tax deduction now. Let's say you make $60,000 this year, and you contribute $6,000 to a traditional IRA. When tax time comes, you might be able to deduct that $6,000. So instead of paying taxes on $60,000, you only pay taxes on $54,000. That's immediate tax savings. Your money grows inside the account tax-free. No taxes on dividends, interest, or capital gains while it's in there. That's awesome. But here's the catch. When you retire and start taking money out, you pay ordinary income taxes on everything, both your contributions and all the growth. It's basically pay taxes later. You're kicking the tax can down the road. Oh, and there's another rule. Once you hit age 73 as of 2024, you have to start taking money out whether you want to or not. These are called required minimum distributions, or RMDs. The government is basically saying, okay, we've waited long enough, time to pay those taxes. Now, let's talk about the Roth IRA. This is the newer kid on the block, introduced in 1997 and named after Senator William Roth. The Roth works completely opposite. You put money in after you've already paid taxes on it. No tax deduction now. So if you make $60,000 and contribute $6,000 to a Roth IRA, you still pay taxes on the full $60,000. No immediate tax break. But, and this is huge, your money grows tax-free, and you can take it out tax-free in retirement. Every penny, the contributions, the growth, the dividends, everything, tax-free forever. Plus, there are no required minimum distributions, ever. You never have to take money out if you don't want to. You can let it grow and even pass it to your heirs. It's basically pay taxes now, never again. All right, let's break down the key differences one by one. 1. Taxation. The big one. Traditional. Tax deduction now, pay taxes later. Roth. No deduction now, tax-free later. Which is better? It depends on your tax bracket now versus your tax bracket in retirement. If you're in a high tax bracket now and expect to be in a lower one in retirement, the traditional might make sense. You get a big deduction now when you're in that high bracket. If you're in a low tax bracket now or expect to be in a higher one later, the Roth makes more sense. You pay taxes now when they're cheap. Here's a simple example. Let's say you're a medical resident making $60,000, but in a few years you'll be an attending physician making $300,000. Right now, you're in a relatively low tax bracket. Roth probably makes sense. Pay taxes now while they're low. Or maybe you're a high-earning professional currently in the 32% tax bracket, but you plan to live modestly in retirement on $50,000 a year. Traditional might make sense. Get that deduction now at 32%, pay taxes later at maybe 12%. 2. Contribution limits. For 2024, both accounts have the same contribution limits: $7,000 per year if you're under 50, $8,000 per year if you're 50 or older. That extra $1,000 is called a catch-up contribution. But here's something cool. Because Roth contributions are after tax, you're actually getting more money into a Roth than a traditional, in a way. Think about it. $7,000 in a Roth is truly $7,000 that will grow tax-free. But $7,000 in a traditional will be less after taxes. If you're in the 22% tax bracket, that $7,000 might only be worth about $5,460 after you pay taxes in retirement. 3. Income limits. This is important. There are income limits for contributing to a Roth, but not really for a traditional. This year, if you're single and make more than $161,000, you can't contribute directly to a Roth. For married couples filing jointly, that limit is $240,000. Traditional IRAs don't have income limits for contributions, but if you or your spouse has a retirement plan at work and you make too much you might not get the tax deduction. So you can still contribute, it just won't be tax deductible. There's something called a backdoor Roth IRA that high earners use to get around the Roth income limits, but that's a whole other topic we won't get into today. Number 4, withdrawal rules. Traditional IRA, you can start penalty-free withdrawals at 5 to 9.5. Before that, you'll pay a 10% penalty plus income taxes. Some exceptions exist. At 73, you must start taking RMDs. Roth IRA, you can withdraw your contributions anytime, tax and penalty free, because you already paid taxes on them. The earnings have to wait until you're 590.5 and the account has been open for 5 years. No RMDs ever. This makes the Roth way more flexible. It can even act as an emergency fund in a pinch, though I don't generally recommend that. Number 5, estate planning. If you want to leave money to your kids or heirs, Roth is usually better. With a traditional IRA, your heirs inherit the account, but also the tax burden. They'll have to pay income taxes when they take distributions. With a Roth, they inherit tax-free money. That's a much better gift. Plus, with no RMDs, you can let the Roth keep growing throughout your lifetime if you don't need the money. Let's make this practical with some scenarios. Scenario 1. The young professional Sarah is 25, just started her career making $55,000 a year. She's in the 22% tax bracket. Best choice? Probably Roth. Why? She's young. Her income and tax bracket will likely be higher later. She's got 40 years for that money to grow tax-free. The tax-free growth over 4 decades will be incredible. And she's not in a super high tax bracket now, so the tax pain isn't too bad. Scenario 2, the peak earner. Mike is 45, makes $200,000 a year in the 32% tax bracket. He's at his peak earning years and plans to retire at 65 with expenses around $70,000 a year. Best choice? Probably traditional. Why? That tax deduction at 32% is valuable right now. In retirement, with $70,000 in income, he'll likely be in the 22% or lower bracket. He's essentially getting a 10% discount by waiting to pay taxes. Scenario 3, the uncertain future. Jessica is 30, makes $75,000, not sure what her financial future holds. Best choice? Maybe both. There's no rule that says you can't do both. She could do $3,500 in a traditional and $3,500 in a Roth. This is called tax diversification. You're hedging your bets. You don't know what tax rates will be in 35 years, so you're preparing for both scenarios. Here's something we need to talk about: future tax rates. Nobody knows what tax rates will be in 20, 30, or 40 years. Right now, we're historically at relatively low tax rates. The current tax law, the Tax Cuts and Jobs Act, is set to expire in 2025, and rates might go up after that. Some people argue taxes will probably be higher in the future, so pay them now with a Roth. Others say you'll have control over your income in retirement, so you can keep yourself in a lower bracket, making traditional better. Both are reasonable positions. This uncertainty is why many financial experts suggest a mix of both if possible. Let me share some mistakes people make. Mistake 1, not contributing at all. The worst IRA is the one you don't fund. Whether it's Roth or traditional, both are way better than not saving for retirement. Don't get paralyzed by the decision. Mistake 2, only looking at current tax bracket. It's not just about what bracket you're in now. Think about your entire financial picture, where you're headed, what retirement might look like. Mistake 3, forgetting about state taxes. Some states don't have income tax. If you live in Texas now but might retire in California, that changes the math, or vice versa. Mistake 4, not understanding the 5-year rule. For Roth IRAs, even if you're over 591.5, the account needs to have been open for at least 5 years to withdraw earnings tax-free. So even if you're 60, if you just open the Roth, you need to wait 5 years. Start early. Mistake 5, withdrawing early. The power of these accounts is long-term, tax-advantaged growth. Don't rob your future self by withdrawing early, except in real emergencies. Here's something interesting. Mathematically, if your tax rate is the same now and in retirement, a Roth and traditional IRA will give you the same after-tax result. Let me prove it quickly. Example, you have $7,000 to invest, 25% tax bracket now and later, and your investment doubles. Traditional approach, invest $7,000 pre-tax, grows to $14,000, pay 25% tax when withdrawing. $14,000.75 equals $10,500 after tax. Roth approach, pay 25% tax first, $7,000 to $5,550 to invest. Grows to $1,500, doubled, withdraw tax-free, $10,500. Same result. The difference is all about whether your tax rate changes. But remember, tax rates aren't the only factor. There's also flexibility, RMDs, estate planning, and the unknowns about future tax policy. So which one is better? Here's my honest answer. It depends. I know that's not satisfying, but it's true. Consider a Roth if you're young with decades to grow, you're in a relatively low tax bracket now, you expect higher income later, you value flexibility, you want to leave tax-free money to heirs, you don't need the tax deduction now. Consider a traditional if you're in a high tax bracket now, you expect lower income in retirement, you need the tax deduction now, you're closer to retirement, you want to reduce current taxable income. Consider doing both if you're not sure about the future. You want tax diversification, you can afford to split contributions, you like hedging your bets. My personal take: if you're forcing me to choose for the average person, and this is just my opinion, I lean slightly toward Roth for most people under 40. Here's why. Tax rates are historically low. The tax-free growth over decades is powerful, the flexibility is valuable, and most young people aren't in super high tax brackets anyway. But that's a generalization. Your situation might be completely different. All right, what should you actually do with this information? Step 1. Figure out your current tax bracket. Google 2024 tax brackets and see where you fall. Step 2. Think honestly about retirement. What tax bracket might you be in? Will you have other income sources like Social Security, pensions, or rental income? Step 3, check if your income allows you to contribute to a Roth. If you're over the limit, that makes the decision easier. Step 4, consider your timeline. The longer you have, the more powerful the Roth becomes. Step 5, just start. Open one or both accounts. You can always adjust next year. Step 6, max it out if possible. Whether you choose Roth or traditional, try to contribute the full amount if your budget allows. Step 7, set up automatic contributions. Make it easy on yourself. Look, here's the bottom line. Both Roth and traditional IRAs are incredible tools for building wealth and securing your retirement. Both offer tax advantages that are way better than just using a regular taxable brokerage account. The perfect choice depends on variables we can't fully predict: future tax rates, your future income, tax law changes, your health, your longevity, and more. Do your best with the information you have, make a decision, and start contributing. The biggest mistake isn't choosing the wrong one, it's not choosing at all. You can also change strategies. Maybe you do traditional for a few years, then switch to Roth when your situation changes. That's totally fine. And remember, if you have a 401k at work, these same Roth versus traditional principles often apply there too. Many employers now offer both Roth and traditional 401k options. The fact that you're even watching this video and thinking about this stuff means you're ahead of most people. So give yourself credit for that. All right, that's the deep dive on Roth versus traditional IRAs. I hope this was helpful and didn't make your head spin too much. What are you using, Roth, traditional, or both? Drop a comment and let me know your reasoning. I'd love to hear your thoughts, and I'm sure others can learn from your perspective too. If you found this valuable, give it a thumbs up and subscribe for more personal finance content. Thanks for watching, and remember, the best investment you can make is in your future self. Now, go fund that IRA. I'll see you in the next one.